So I thought this would be interesting. A subscriber sent me his trades, a subscriber that's actually just following my trade alerts. And I thought I'd make a video showing his trades because they're pretty nice actually. And I wish I had these trades actually. So this subscriber has a $100,000 Canadian account, brand new account, margin account opened with Questrade. And all he's doing is selling naked put. So basically the majority of my trade alerts. So let's go through each trade one by one. So the first trade here was Baidu naked put. It was opened August 11th, closed August 13. So this looks like a naked put at a 152.5 strike with an August 13 expiry, closed August 12, $73 net profit. So open for $1, closed for 15 cents. So let's go look at the chart here, August 11th. So it looks like it was an earnings trade. So August 11th, Baidu was trading at 164. And then the next day, it actually dropped the next day, August 12. As you can see this drop here on the chart. So from August 11th to August 12th, it dropped to 158. So even though it dropped, because the strike was way out of the money, it was a 152.5 strike. The strike was still safe enough for the trade to be profitable. So when you sell a put option at a 152.5 strike, for example, you win, you make profit as long as the stock stays above this strike come expiry of August 13. Because it was 1 day to go and the stock was trading at around 155 and higher, the put option lost a lot of value. So it went from $1 to maybe 30 cents and even less to 15 cents because it was a volatility contraction, because earnings had just passed, there's no more uncertainty. So the value of the premiums drop, and he was able to close a trade for 15 cents, giving him a $73 net profit 1 day trade. This is US, of course. Next trade here was Posh. So this is most likely after earnings, after Posh dropped a lot after earnings. So let's look up the chart of Posh. I had this trade actually, but I had the 35 put, sadly. So this is August 11th as well. So yeah. So yeah, you can see it over here. August 10, it was trading at 33. August 11, it dropped to $28. So this trade was open after earnings, after the big drop happened. And the strike was 30. So the strike was already in the money, but collected $4. So when you collect $4, that puts your break even at 30 minus 4. So the break even at expiry of September 17, the break even is 26. Posh, I believe later on, I guess it was August 12. So the next day, another 1 day trade. August 12, it went back up or slightly up, and the trade was closable for $1 profit. So from $4 to $3, giving him an $88 net profit after commissions. Next here, we've got AirBNB. So this is a naked put as well. AirBNB 140 strike. So this was before, this is an earnings trade. So open on August 12, closed August 13. It had an expiry of August 13. So from $1 and 1, collected $1.01, closed it for 10 cents. So let's look up the chart here for AirBNB. So AirBNB on August 11 was trading at around high 140s. The strike here was 140. And I think the stock dropped after earnings. I don't remember. So from August 12, actually we're looking at August 12, sorry. So August 12, this stock is trading in the 150s, and then August 13, it looks like it went up and dropped as well a bit, but then came back up again. So obviously it was an easy winner, especially since it was expiring the same day. This could have been held to expiry and expire worthless, so they didn't have to pay 10 cents in commissions, but regardless, it was another profitable trade here. Closed for 10 cents, giving him $79 net profit. So the capital required for these trades here, well, it'll depend on how out of the money they are. So initially Baidu was trading at around, I believe, 160. So it'll take, so every broker is different, but it's going to be similar. So with Questrade, Baidu is a 30% margin requirement stock, so it'll be around 30% times 160 minus how much out of the money it was. So it was about 8 points out of the money, so minus 8 times 100. So it took about $4,000 of maintenance excess for that trade here. Posh is also a 30% margin requirement stock, so 0.30 times the stock of the price, but this time it's 2 points in the money, so it's plus 2. So it took about times 100 because it's one contract. So it took about $1,000 of maintenance excess for this trade here. AirBNB, 140. The stock was at around 150. So 150 times 30%. With Questrade, it's a 30% margin requirement stock. So 30%, so 45 minus 10 points because it was 10 points out of the money times 100. So it took about 3,500 of maintenance excess for AirBNB. Next here we have Dash. So Dash was another naked put for earnings as well, 167.5. And I believe Dash was trading in the high 180s before earnings. So we're looking for August 12 here. So August 12, it was trading at around, high 188. And then August 13, it dropped to 181. So it did drop after earnings, but look where the put was. The strike is at 167.5. So as long as it stays above 167.5, the trade's a winner. We keep the $1.15 profit. So there you go. Close for 15 cents the next day. Could have expired worthless, but close it for 15 cents, giving him an $88 net profit. Now Dash, because the strike is higher, is going to take more. There'll be more. It's a higher capital requirement. So if Dash is trading at 188 times 30%, because it's a 30% margin requirement stock with Questrade, minus how out of the money is it? It's about 20 points out of the money because my strike is 167.5 times 100. So it's about $3,600 of maintenance excess for this trade. And then next here, Fiverr, a naked put on Fiverr at a 150 strike for $4.20, September 17 expire. So this one was done after earnings when Fiverr dropped hard after earnings. So let's look at the chart for Fiverr because it was a big drop actually. So yeah, you can see this drop here. It was trading in the 230s. It dropped all the way down to 176. So it was open August 10th. So it was open around here when the stock was trading at 176. Took the 150 strike, collected $4.20, and then on August 13th, so 3 days later, it was closed for $3.10. So that's a net profit after commissions of $98. So that week of August 13 expiry, there was a net profit of about $429. Now, Fiverr, let's look at the capital requirement for Fiverr. So Fiverr is a 30% margin requirement for Questrade. So 30% times price of the stock was about 176 minus how out of the money is the strike. The 150 strike is about 25 points out of the money, so minus 25 times 100. So it took about $2,700 or $3,000 of capital requirement or maintenance excess to place this trade. So not bad actually. Target here, so the next trade here is Zillow, Z. Opened August 17th, closed, not sure if it was closed the same day, but whatever, maybe it's a typo. So let's just look at the chart. So Zillow, August 17, 85 strike. Yeah, it was probably closed the same day. Yeah. All right. So let's look at August 17. Yeah. So it was at the lowest point. Yeah. So August 17, Zillow, as you can see on the chart here, reached its lowest in the past month. So the strike here was 85 strike for $3. September 17 expiry, closed the same day for $2.17. I guess because the stock came back up the same day. So that's a good profit, good 1 day profit, $71 net profit. Zillow, how much capital requirement for Zillow? So it's a 30% margin requirement as well for Zillow. So times the price of the stock, it was trading at around 189. And then the strike chosen was 85. So it's about 4 points out of the money. So 22 times 100. So that's 2,200 capital requirement for that trade. So pretty good. Target here was an earnings trade. All right. Target was an earnings trade. Opened August 17th, closed August 18th. So from open for $1, closed for 20 cents. Quick $68 net profit. It was a 235 strike. So let's look at the chart for Target. So Target was trading before earnings. So August 17, it was around here. So it was trading in the low 250s before earnings. After earnings, it dropped to around high 240s, low 250s. But the strike was 235. So the strike was still safe. With an August, I believe it was August 20th expiry, but it had a few days to go. So the trade was closed for 20 cents the next day. So that's that $68 net profit. And then next, Nvidia, another earnings trade on Nvidia. This is open August 18th, closed August 19th, so the next day. So open for $1, closed for 20 cents. Now let's look at Nvidia. Now remember, Nvidia was a little bit annoying because it actually dropped a lot, but then flew the same day. So it was a bit annoying because it was closed for no reason. Could have expired worthless easily. So $1 from $1 to 20 cents, not bad, but because of commission, you're left with $68 net profit. So let's look at this trade. So August 18th to August 19th. So August 18th, Nvidia was trading at 193, and then the next day it dropped. It actually dropped to high 180s, but then I think same day it flew all the way to 200 or 205. So definitely closed a little bit too early, but regardless, it was a quick earnings trade. That's the fun part with earnings. Next here was also how much capital. Let's look at the capital requirement for Target and Nvidia. So Target was a pretty high one, of course. The stock's at 250, so it's a 30% margin requirement. So 30% times 250 minus the difference between the strike and the current market price. So 250 minus 235 is about 15, so minus 15. So it took about times 100, so it took about 6,000 capital requirement or maintenance excess for this trade. Next, Nvidia was a 180 strike. The stock was trading at 190 something. So 0.30% times 190 minus 10 points out of the money. So 40, because the strike is 180. So 47 times 100. That gives you 4,700 maintenance excess for the Nvidia trade. So next we've got Spotify. So let's look at the capital requirement at the same time. So I think Spotify, at the 190 strike, was open August 16. I think Spotify was trading at I think 210 or maybe 205. So and it's a 30% margin requirement. So let's just say 205 minus 15 points because the strike is 15 points out of the money. So it took about 4,600 US maintenance excess. So let's look at the trade. So Spotify just at some point just kept dropping and dropping. I have in my personal account, I have a naked put on Spotify at a 240 strike. So yeah, that's annoying. Right now it has gone back up a bit, but still at 226. So my put is still in the money. So we're going back to this trade here. This is a 190 strike on Spotify. So it was open August 16. So it was open August 16 when, there you go, Spotify was trading at 207, 206, and then it was closed August 20th. So a few days later, so actually it was on expiry, yeah. So the expiry was September 17th, but it was closed on Friday, and it was closed for $2. So from $3 to $2, that's a $1 profit. And it was definitely closed early because if it was held a little bit longer, definitely would have been closed for much less, maybe even would have made a $2 profit on this trade instead of a $1 profit. Because as you can see, Spotify jumped later on. Regardless, it's still profit. Next here, there was a Spotify 200 put here. This was open August 10th. So this one was held longer. So obviously it was open before this one, but it was held longer because it was a 200 strike, so it was not closable. Not only was it held longer, but it was rolled at some point. So as you can see up here, first time collected 3.6, so $3.60, and then collected $2.95, rolling it from September to October. But then was able to close it for $4.70. So that gave him a profit of $173 net profit US. Now the capital requirement now for Spotify, it's 30% margin requirement. The strike or the stock was trading at 205. I already did this one. So yeah, actually let's look at the other one, the 200 strike. So the stock was trading at 205 and then minus 5 because it's only 5 points out of the money. So it's about 5,600 maintenance excess for that one. So next here, we've got a Best Buy naked put at 108. So this was for earnings as well. This was good actually. So open for $1.20 right the day before. So August 23rd, closed August 24th. Open for $1.20, closed for 10 cents the next day. So that's a quick $98 net profit. Let's look at the Best Buy chart here. This was an earnings trade. So I could probably just look at 5 days. So yeah, it was open right over here when the stock was trading at 112. So actually volatility in Best Buy is not that high. So you can't even go that far. So stock was trading at 112 and the strike was 108. Collected $1.20, but then closed the next day because luckily Best Buy went up. But that's the beauty of earnings is when you sell, that's why I personally like to sell out of the money puts, because it gives me more chance of winning. The stock can fly, I'll win. The stock can be flat, I'll also win. And there's actually room for the stock to drop. As you could see in many of these examples up here, the stock did in fact drop after earnings, but the put option was closable still, even with the stock dropping, making the trade profitable. So I don't have to guess the direction. I'm just hoping or giving room for the stock to move wherever it wants, and it can still profit. And if on those rare occasions where it drops 10 or 20% and drops below my strike, then I have to roll. That's the bad part, but it doesn't happen often. So that's Best Buy. The capital requirement for Best Buy, I mean, it was near the strike, so it wasn't that far out of the money. So it's about 30% times 110. So it's about 3,300 capital requirement for Best Buy. Next here we've got Baba. So Baba was fun because the premiums on Baba were ridiculous for October expiry. I mean, this put option here that was sold for $5, at some point I think it was worth $8. The 130 strike for October 15 was worth $8. So it wasn't even the best entry. But then when Baba jumped back up to I think 171, then the trade was closable for $3.30, and it wasn't even, could have been closed for better, but regardless, it was still a good profit. Could not ignore, since obviously these Chinese stocks are super all over the place. So let's try to find the trade here. So Baba was open August 20th. No, I'll have to go 1 month. So it was open around here, as you could see. Baba's trading at 159, and it still dropped after that to, I think it reached 149 at some point. So yeah, it was open at around August 20th, so around 159. The 130 strike for $5.05, and then it was closed. It was closed August 24th. So August 24th, it was closed on that jump over here when Baba went to 173. So closed for $3.30. So that's $163 profit. The capital requirement for this trade is 30% times the price of the stock, so 159, minus how out of the money it was. So 160 minus 130 is about 30 points. So that's good actually. So it took about only 1,700 maintenance excess for that trade, only because the stock was very out of the money. The strike was really out of the money. And let me just make sure here by putting it in this formula here. So market price is 159 for Baba. The strike was 130, and I'm doing one contract. So yeah, the capital requirement is 1,870. Yeah. Next here we've got AI. So this was a trade where I changed my mind and I sent an alert to close it. So from 250, it was a small profit, just a change of mind. So it was closed quickly for a small profit. So Baba here was a trade that was open before this one, actually before August 20th. So it was open August 19th at a 145 strike for $5. Now this one here was worth $11 at some point. So definitely not the best entry. So it was open for $5, closed for $3.90 on August 24th. So it's the same, approximately the same timing as well. It was closed at the same time, but this one was open previously at a bad entry. And then Zillow here was a 95 strike. It was opened before this one over here, of course. Open for $3.10, closed for $2.10 as well. So $88 net profit. And this one here was, I actually saw this from MarketChameleon. It had high volatility. So I noticed the 100 put was going for $2. At some point it was actually worth $2.50. So not the best entry, but still went for $2. It was closed for $1. And that's a net profit of $88. Next here, Pinterest. Now, in my account, I've got the 65 put, but this alert was sent after Pinterest dropped after earnings, I think more than 20%. So this is definitely a much better strike. It was open for $2. Did 2 contracts because the account size is bigger, 100,000. Now, at some point, this put option was worth, I think, over $4. So once again, it wasn't the best entry, but was still closable after a few days for $147 net profit. Now these two here, Peloton, favorite stock here to trade. This was before earnings, so let's look at the Peloton chart here. This is another example of why I like out of the money puts. So look at this. Peloton dropped 8% after earnings. 8% after earnings. But because we had the 100 strike or the 102 strike, which is out of the money, when Peloton, if we do the 5-day chart, Peloton was trading at around 114. So we sold the 100 and 102 strike, well, depending on the timing. If you did it earlier in the day or end of day, because as you could see, Thursday, it jumped to 120, but then the whole day started dropping and closed lower. So depending on when you took the trade on, you either had the 100 or 102 strike. This subscriber did both, actually. Did the 102 and the 100 strike. It's as if he started off with doing 2 contracts, but in fact he just scaled in and did a second contract at a better strike. So collected $1 on each strike. And then the next day, obviously Peloton closed at 140, as you can see here. So they would have expired worthless. So could have been closed, could have been closed without paying anything. But regardless, paid 30 cents to close both together. So that's a net profit for both Peloton trades of 153 US. So these were earnings trades, and so most of them, as you can see, most of them were earnings trades. Now let's look at the capital requirement for Peloton. So Peloton was trading at 114 before earnings times 0.3. It's a 30% margin requirement stock minus the strikes of 102. So it's minus 12 points. So it's about 2,200. But this time it's times 200 because there's 2 contracts, right? So it took about 4,400 maintenance excess US for Peloton. So let me just put it here just to make sure. 114, 102, yeah, 2,200. Okay. So yeah, so that was a Peloton trade. And that actually gives this subscriber a P&L of about, actually let's refresh just to make sure. So yeah, 1,777 US. For the month of August, but obviously the month of August was not started from the beginning. So this subscriber started, actually looks like it started August 9th. Probably started this week over here. So 1, 2, 3 weeks. So this is in 3 weeks of August. So just so we know exactly how much the account had, it started off with a $100,000 Canadian account, and this is US. So I'm just curious to see what the return is per week. And this is why I like naked puts, because as you can see, this subscriber actually has no open trades. All his trades are closed, so he's in cash right now. So going into the weekend in cash is pretty fun, and you're starting the week fresh with all your account all in cash and ready for new opportunities. So this is exactly 3 weeks of trading or selling puts. Now let's just see what the return is. So 1,700 times, I think US rate is at 126 right now. It keeps going up and down. So that's 2,239 Canadian in 3 weeks, divided by a $100,000 account. So that's 2.2% in 3 weeks. So let's divide by 3 and then times 52. So that's about a 38% return annualized if the subscriber continues at this pace. So obviously it's hard to tell. It's only 3 weeks, means nothing, but this is what it represents right now. It represents a 38% annualized rate of return while still having 100% of his cash. So I thought it would be interesting to make a video about it. I mean, the trades look nice. Well, they're basically the trades that I sent out. If only I had that size of an account, or that account size, these would be the trades that I'd be doing for sure. But at some point, I think it was not last week, but the week of between August 16, August 20th, it was pretty red. The market was pretty red, and a lot of these puts were showing a big paper loss. So it was quite stressful for someone starting off. So let me know what you think of these trades. Leave in the comments section below. If you have any questions as well, leave in the comments section below. Like always, if you can open an account with Questrade to sell options, use my referral link below to get $50 in free commissions. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.